Understanding the Basics of Investment, a Beginner's Guide. Embarking on the journey of understanding the basics of investment is like unlocking the door to financial empowerment. Number 1. Define your financial goals. Defining your financial goals is the foundational step in the investment process, and it involves setting clear objectives for what you want to achieve with your money. This process is highly personal and varies from individual to individual. Financial goals should be specific, measurable, achievable, relevant, and time-bound, SMART. For example, instead of a vague goal like save money for the future, a SMART goal would be save $10,000 for a down payment on a house within the next 3 years. Risk tolerance is the extent to which you can handle fluctuations in the value of your investments. For short-term goals, you may lean towards safer, more stable investments, while long-term goals may allow for a higher level of risk to potentially achieve higher returns. If, for instance, you value environmental sustainability, you might consider investments in socially responsible funds. Your financial goals should align with your lifestyle and personal values. Understanding your values can guide you in choosing investments that resonate with your beliefs. By clearly defining your financial goals, you can make more strategic decisions about where to allocate your resources. This clarity helps you focus on investments that are directly aligned with your objectives. If you are enjoying this video, don't forget to hit the subscribe button and turn on notifications for this channel. Let's continue. Number 2. Learn the different investment vehicles. When delving into the world of investments, understanding the various investment vehicles is fundamental to crafting a diversified and effective strategy. Investment vehicles are essentially the different avenues through which people can invest their money, each with its own characteristics, risk profiles, and potential returns. An example of these common investment vehicle is bonds. Bonds are debt securities where investors lend money to governments or corporations in exchange for periodic interest payments and the return of the principal at maturity. Bonds are considered safer than stocks and provide a steady income stream through interest payments. They are often used for income generation and capital preservation. Stocks. Buying stocks means purchasing ownership in a company. Investors become shareholders and may benefit from capital appreciation, stock value increase, and dividends. Stocks have the potential for high returns, offering ownership in thriving companies. However, they come with volatility and risk, making research and a long-term perspective crucial. Understanding these investment vehicles is crucial for beginners as it allows them to tailor their investment strategy to their financial goals and risk tolerance. Diversification, achieved by spreading investments across different vehicles, helps manage risk. Number 3. Understand risk and return. Understanding risk and return is a fundamental concept in the world of investments and is crucial for anyone looking to grow their finances. This concept explores the relationship between the potential gain an investment offers, return, and the likelihood of losing some or all of the invested capital, risk. Risk in investing refers to the uncertainty or variability of returns. It encompasses the possibility of losing some or all of the invested capital. Return is the gain or loss made on an investment relative to the amount invested. It is the reward for taking on risk. Investments with higher potential returns typically come with higher levels of risk. Stocks, for example, have the potential for significant returns, but are also more volatile than bonds. Risk tolerance is an individual's ability to withstand the potential loss of their investment. It varies from person to person based on factors such as age, financial goals, and personal temperament. Investors with a higher risk tolerance might allocate a larger portion of their portfolio to riskier assets, seeking higher returns. Those with a lower risk tolerance may prefer more stable, lower return investments. A well-diversified portfolio may include a mix of stocks, bonds, real estate, and other assets. Understanding the risk-return relationship enables investors to find a balance that aligns with their financial goals. Number 4. Create a budget and emergency fund. A budget is a foundational element of personal finance and a crucial aspect of understanding the basics of investment. It is essentially a detailed plan that outlines your income and expenses over a specific period. Start by identifying all sources of income, including your salary, freelance work, dividends, or any other revenue streams. Ensure that you have a comprehensive understanding of your total monthly or annual income. Categorize your expenses into fixed and variable categories. Fixed expenses, like rent or mortgage payments, remain constant, while variable expenses, such as groceries or entertainment, can fluctuate. Creating categories helps you see where your money is going and identify areas where you can potentially save. If you find that you're consistently overspending in certain areas, consider adjusting your budget to better align with your financial goals. An emergency fund is a reserve of money set aside to cover unforeseen expenses or financial emergencies. It acts as a financial safety net, providing a buffer that helps prevent the need to tap into investments or incur debt during unexpected circumstances. This ensures that your investment strategy remains intact, and you can stay focused on your long-term financial goals. Number 5. Stay informed and seek professional advice. Staying informed is a fundamental aspect of successful investing, especially for beginners. It involves regularly updating yourself on financial news, economic trends, and market conditions. Being aware of market trends and conditions allows investors to make informed decisions. Economic indicators, geopolitical events, and industry-specific news can impact the performance of different assets. Staying informed provides access to educational resources, helping investors understand different investment vehicles, strategies, and financial concepts. This knowledge empowers you to make more informed decisions and avoid common pitfalls. While staying informed is crucial, seeking professional advice adds another layer of expertise to your investment journey. Financial professionals, such as certified financial planners or investment advisors, can provide personalized advice based on your financial goals, risk tolerance, and time horizon. If you found this video helpful, make sure to like this video right now, subscribe to this channel, and hit that bell button for more tips on personal finance. Check the link below for the playlist on these topics. There are more information you would not want to miss. Thanks for watching and see you in the next video.